Good morning. It's February 2nd, 2010. I want to share a couple charts with you. This is a Bureau of Economic Analysis, Federal Reserve, historical statistics of the United States, colonial times through third quarter 2008. The third quarter 2008 was before the infamous Paulson stick-up and bailout for Wall Street. And the $1.6 trillion deficit spending and debt increase of the federal government in 2009. We can see here the Great Depression in 1933 hit a peak of almost 300% of GDP. We could see that before the crisis began in the United States, we were at 360% of GDP. We all know that the Great Depression started in 1929 and really manifested full-blown by 33, okay, about 3 years later. We all know that in 2008, the big crisis really blew in a major way, and I would say by 2011, that is going to be the peak of this debt spike. Will it be 450% of GDP? I don't know. I don't know how much longer the government can keep, this show going, and how long the whole world will continue to put up with us and put up with basically just nothing but lies, and there's just absolutely no touch with reality whatsoever on the point of our government. We can see that historically, that total debt as a percentage of GDP has been much, much lower. We can compare the spike that occurred in the late 20s and early 30s, like a wave, a big wave. And this is a tsunami, and it's still growing. And it's threatening to wash everything away. There's only one way to bring the debt down. It's either through hyperinflation or through a total deflation or a combination of the two. Either way, you're talking massive devastation. Let me share another chart with you. Housing chart, Case SHiller. Case SHiller does a very respectable job of putting together analysis on long-term housing trends. Here we have a history of home values, and we can see going all the way back to 1890. This is the trend line. Here we can see from 2000 to 2007, 2006, 2007, it was a massive boom. We have currently declined to about here, okay? And this was actually published, I believe, in the New York Times, called Irrational Exuberance, okay? So what's happening is housing prices have to come down, historically speaking. They have to revert to the mean. And in the meantime, Wall Street has sold toxic paper, and they've leveraged it 20 to 1, 30 to 1. And there's derivatives. In other words, trillions and trillions and trillions of dollars of insurance contracts insuring the income streams on these instruments throughout the world, and their value is based on the value of the asset that is underlying in other words, the collateral is the housing and the real estate. So what you could see here, that prices have to come down, and prices have been falling, but the government has been using all their policies, basically borrowing money that we don't have to try to prevent this trend, because I guess you could say the alternative is even worse, and that would be to allow the value of assets to decline that are underlying all these collateralized debt obligations and derivatives, and would create a complete implosion. However, they can't prevent the housing prices from declining. They can only stop it for a while. They've been doing so with the $8,500 tax credit for first-time buyers. Last year it was $6,500. I believe they're giving a tax credit to home sellers that are going to sell their home. The Fed is actively purchasing mortgages. 80% is a roundabout figure I've seen. They're purchasing 80% of all mortgages in order to artificially keep interest rates suppressed, which of course makes housing more affordable and have more appeal. So the government is literally goading people into purchasing homes. And Donald Trump is even out there. He took out a full page ad in my local paper about he's giving seminars all over the country. Now's the time to buy real estate. Don't miss out. Okay? Don't be left behind. Well, if we look at this long-term housing chart, we can see that real estate has no other way to go but down. Okay? So people that are purchasing homes are they're going to get hurt. No doubt about it. Whatever your house value was in 2007, you can probably take 80% right off the top, and that's about what your house is going to be valued at in real terms. Okay? When this mess is over, it's going to be significantly less. Now I'm going to give you one more chart, the gold Dow ratio. When you divide the price of an ounce of gold, you get a ratio. And you can see here that this is a long-term chart. And we're right here in 1999. It took 42 ounces of gold to buy the Dow. In other words, you divided the gold price into what the Dow was at. It went in 42 times. We could see that we've been in a crash mode. Now this chart is only current for 2008. We have literally dropped to here. We're about 9 right now. Now you can see that the trend, the long-term trend over the last 100 years has always been that the Dow Gold has hit 1 twice and has bounced along between 1 and 5 for quite a number of years before another financial bubble took place. And so this Dow Gold ratio is telling you that we haven't hit bottom in stock prices, that anything that we've heard out of Wall Street or CNBC or our government is nothing but spin. Remember back in 2007 when the Dow hit 14,000, they were talking it up big. But you could see here that in reality, okay, it was only a temporary stop in the complete decline and breakdown and collapse of stock values in relation to gold price. And gold gives you the true and real value. So keep your eye on the Dow Gold ratio. When that hits 1, then it can't get any worse, okay? And the bottom has been reached. I'm going to share I'd like to share more charts with you, but I'm going to probably run out of 10 minutes here. But I think you get the message. Things are still going to get worse. Things are very, 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 very dire. And you are not to be goaded into a false sense of security by the mainstream media, your government, or any spin that Wall Street may have, or folks like Donald Trump. Okay? Take care, and have a good day.